Okay, so let's start our class. So good evening, everyone. You're welcome to another class on financial reporting. So today we are going to be starting a fresh topic. Of course, another accounting standard. And this standard deals with it's on IAS 36 that looks at impairment of assets. So what we have achieved so far is looking at accounting standards that deal with assets, at least on my own part of the syllabus. We have looked at assets like PPE. We have looked at assets like intangible assets. And we have also looked at a scenario where an asset is being rented, where you can't buy an asset outrightly, then you have to rent it from another party, where we looked at that under IFRS 16 on leases. Now, what we want to learn today is that these assets, both the tangible one, that is the PPE, and the intangible one, as covered under IAS 36, we want to learn that these assets usually impair. They can impair. So what we'll cover first, we'll look at the objective and the scope of this IAS 36. Then we will try and understand how can we know when an asset is impaired. Then we'll look at a terminology called recoverable amount. We will look at how we measure it. Then you look at how you recognize and measure impairment loss generally. Thereafter, we will learn about cash generating units and goodwill. Then we will look at reversal of an impairment loss. And finally, we'll look at disclosures. So basically, these are the areas we want to look at under this standard. So the first part is, why are we learning this standard? What is the objective of this standard? Like I've mentioned before, the objective is to ensure that an entity is just to ensure that an entity that has an asset must ensure that the assets are carried at no more than their recoverable amount. That's the first thing we will learn here. That the assets you have in your books their value should never be higher than their recoverable amount. We're going to decipher that very soon. And also, another item or aspect we're going to learn tonight is to see how we can reverse an impairment and also disclosures. So this standard on IAS 36, majorly from this objective, you will see that the emphasis is ensuring that the value of an asset is not more than the recoverable amount of that asset. And if for whatever reason, the carrying amount now becomes higher than its recoverable amount, then you would describe that asset as being impaired. And also we're going to learn about reversal and also disclosures. So the assets we are talking about that we are considering here majorly is about assets that are tangible, and also that covered in IAS 38, which is intangible assets, and some aspect of financial assets. right? Some aspect of financial assets. Okay, that's those that are not covered by IAS 32. We are still going to learn IAS 32. So the focus of the assets here that we want to learn about is tangible and intangible assets. So we are not looking at impairment of inventories, deferred tax assets, and some other types of assets that are dealt with in other standards. That's not our focus tonight. Okay, having looked at the objective of this standard and also the scope, and don't forget, the key objective here is that make sure at every point in time, as an accountant, as a student also, that your book value of either your tangible or intangible asset is never higher than your recoverable amount. That's what we want to ensure here. That's what we want to learn, that if it does at any point in time, then you know that that asset is impaired. That's majorly what we want to look at in detail. So before we look at more details, let's look at some definitions that will be relevant to us as we move along. The first one here is an impairment loss. An impairment loss. So an impairment loss is the amount by which the carrying amount of an asset or a cash generating unit, I will tell you what that is very soon, exceeds its recoverable amount. So this is clear in the sense that what this is saying is that when your carrying amount is higher than your recoverable amount, right, the amount by which the carrying amount exceeds that recoverable amount, that amount is called impairment loss. And don't forget, the objective of this standard is to ensure that your book value or the carrying amount of an asset never exceeds its recoverable amount. But if it happens like that, so the amount at which it exceeds it, that's an impairment loss. It's assumed that there is a loss happening on that asset. It's a loss. Now, so there are two relevant points here that are key. Number one is carrying amount. Number two is recoverable amount. By now, you should know what a carrying amount is, which is the amount at which an asset is recognized after deducting any accumulated depreciation or amortization and accumulated impairment losses. You know that already. That's carrying amount. Recoverable amount is the new one here. Recoverable amount is the new one here. And recoverable amount of an asset is defined as the higher of its fair value minus cost of disposal and its value in use. So recoverable amount is the higher between fair value minus cost to sell. This fair value minus cost to sell, you will see that it can also be called net realizable value and its value in use. So when you have net realizable value and you have value in use, the higher of the two is recoverable amount. Then what is fair value? Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. This is a new definition to you guys, which I would advise that you learn, you know. I might not ask you the definition of fair value now, but start getting used to it because it's a popular definition for fair value. But for you now, the simple meaning of this definition is just that fair value is the selling price of an asset. Selling price of an asset. That's fair value. The price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Fair value. Next one is value in use. And value in use is the present value of future cash flows from using an asset, including its eventual disposal. So value in use is just saying that if I continue to use this asset, how much will I get all through the use of this asset? But I want to know how much I will get. What's the value of how much I will get today? Today, what's the value of everything? That if I use this asset for 5 years, okay, what's the total value of what I will get from using this asset for that 5 years? But I want you to get me that value today. So they would estimate future cash flows, future benefits that you can get from that asset. They will get their present value, including how much you will sell the asset eventually. They will get the present value of that too. That's value in use. So by the time the examiner gives you fair value and they give us value in use, the higher of the two is recoverable amount. Then from this definition, that goes to show that recoverable amount from the name is how much you can recover from an asset, either from selling the asset, which is fair value, or from using the asset, which is value in use. So you can define recoverable amount like that as well. That the amount you can recover either from selling an asset or from using it. Because let's face it, those are the two ways in which you can make money from an asset. If there's anyone here that knows any other way, let us know. But from the perspective of this standard, those are the two ways you can make money. And that's what we term as the recoverable amount of an asset. Then this should start making sense to you now. When we say that, the objective of this standard is that we need to ensure that the book value or the carrying amount of an asset does not exceed its recoverable amount. That should make sense to you now. Because why would you record the value of your asset as 20 million? When what you can recover, either from selling or from continuing to use that asset, is 16 million. What you can gain, whether you sell the asset today or you continue to use this asset, the maximum you can get is 16 million. But in your books, you are carrying it at 20 million. You are overvaluing your asset. We don't want that. We don't. That is why they say that if that is happening, it means that there's an impairment loss. Write it off to P&L. It's an impairment loss. Write it off. We don't want that. And that's all we want to learn here. How do we do that? How do we do that? So, again, the basic principle underlying IAS 36 is straightforward. It's straightforward. That if an asset value in the account is higher than its realistic value measured as its recoverable amount, the asset is judged to have suffered impairment loss. It should therefore be reduce the value of the asset by the amount of the impairment loss. The amount of impairment loss should be written off to P&L immediately. That is all. Everything they have in this paragraph, I've summarized everything we want to learn here today. If the value of an asset in the account, if it is higher than how much you can recover, which is the realistic value, how much you can recover is either from selling or from using. If what you are now carrying in your book is higher than that, that means the asset has suffered impairment loss. You need to reduce the value of that asset to its realistic value and write off that impairment loss to profit immediately. You need to master this paragraph. Extremely important. Okay, so in order to get to this level that we just summarized in this paragraph, there are three things we need to learn very quickly. Three things we need to learn. Number one is that how do you even know that there is an impairment loss? Because I'm just saying recoverable amount, recoverable amount, recoverable amount. It's not like the recoverable amount is readily available. Is it something you'll be doing every year or what? So how would you know? What would trigger that action that, okay, it seems this asset has been impaired? So we'll learn about how to identify an impairment loss. Number two is how do you then determine this recoverable amount? Number three is how do you report for impairment loss? These are the three things we want to learn. So the first one is how do you identify that an asset has been impaired, either tangible or intangible? How do you identify that it has been impaired? So there are indicators that we look out for. There are indicators we look out for. So these indicators, we have segregated them into external indicators and internal indicators. In total, I have 6 in front of you. For the external, from the name, that means this mostly are indicators that are outside the control of the company itself. And number one is where there is a fall in the market value that is more significant than would normally be expected from passage of time over normal use. So the assets market value fell. So there is a fall in the value of the assets. When there is a fall, and this fall is not just is so huge that we cannot attribute it to that, okay, it's because of we are using it, that's why the market value fell. Or it is so much that we should consider a possibility that, okay, maybe this asset has been impaired, a fall in market value. Number two is when there is a change in technology, market, legal, or economic environment of the business in which the assets are employed. You see, this is very logical because a change in technology can render the value of an asset to fall, really. A change in technology, even a change in economic environment. Look at a company that is into, let's say, um, let's say a company that is in the oil and gas industry in Nigeria, for example. With the introduction or the beginning of Dangote to be selling refined petrol into the Nigerian market, a lot of companies in that sector would have a lot of assets that would now not be useful again because of the fact that Dangote have started refining. Because most companies, they would import from foreign countries. A lot of oil and gas companies have that license from NNPC to import. And they usually have this huge depot that they dump their imported fuel. But with this refinery, those depot ordinarily is an asset. With this refinery now, the value of the asset would fall. That's a change in economic environment, even a change in legal environment. If the legal framework in a country should change, it can affect some assets, even market environment, even technological environment. So they are indicators. If any of these can affect your assets, then you need to, it's going to trigger that initiative in an accountant that we need to recheck the value of this our asset. We might be overvaluing it. Another one is increase in market interest rates or market rate of return on investments likely to affect the discount rate used in calculating value in use. So at a theoretical level, right, value in use, requires that you get present value. You get present value of future cash flows. And when you want to get present value, you use a discount rate. And you see, these discount rates, they are usually determined by the market rates, the lending rates, or the MPR. And by calculation, the higher these interest rates, the lower the value in use you would get. Some of you that have been taught net present value, you would know that net present value is just giving you estimate of future cash flows and getting their present value. And if you have noted, the higher the discount rates, the lower the value. So theoretically, when interest rates increase, value in use decreases. That's an indicator. So with CBN continually increasing MPR, for some entities, it could be a trigger to test the asset for impairment. It is because it's an indicator. And finally, is if the carrying amount of an entity's net assets is more than its market capitalization. Imagine an entity that is quoted on the exchange. You are quoted on the Nigerian stock market, and your market capitalization is now lower, is lower than your book value, your net asset. It's a trigger, it's an indicator. So all these are indicators of impairment, though external, from fall in market value to change in technology, market, and legal environment, to increase in market interest rates, to the carrying amount of net asset being higher than market capitalization. They are indicators of impairment loss. Then we have the internal indicator. So this one are within the control of the entity. There are things they are seeing themselves. Number one is evidence of obsolescence or physical damage. I mean, the most important one for us here that's very clear is physical damage. When an asset is damaged, is an indicator that the asset value might have gone down. It's an impairment loss indicator. Number two is where there is adverse or negative change in the use to which the asset is put or the asset economic performance. I mean, an asset that was doing 1,000 units per day before and now only do 750 units, from 1,000 units to 750 units. That's an adverse change in economic performance or adverse change in the use of an asset. An asset that you were using sparingly before, but now its use has increased. Even though it might generate more benefit to you, but it's an indicator. Because when you're overusing it, could be an indicator too. So either adverse change in the use or in its asset economic performance, either of them can trigger an impairment loss test. Then another one is when there is a reduction in the remaining life of an asset, that is also an indicator of impairment loss. You see, when you carry out or check for these indicators, we call it impairment review. We call it impairment review. So when it is confirmed that, okay, these indicators are present, when it is confirmed that, okay, one of these indicators is present, then the next stage is the asset will then be tested for impairment. So testing for impairment involves that is when you would then need to calculate the recoverable amount of the asset, which you are now going to compare with the carrying amount of the asset. That's impairment tests. In fact, the first stage for impairment is indicators of impairment, which is impairment review. After impairment review, the next phase is impairment tests, which is where you are now going to calculate recoverable amount and compare this with its carrying amount. Finally, when you check an asset for impairment and there is no indicators of impairment, the following assets must always be tested for impairment. From what I've said earlier, that okay, when you do impairment review, which is looking for indicators, and you confirm that okay, any of those indicators they are positive, they are present, then you would test the asset for impairment. That means if they are not present, you will not have to test. But now we are saying that even if there are no indicators, that there are some assets that every year, whether there is indicator, whether there is no indicator, every year you have to test them for impairment every year. Number one is an intangible asset with an indefinite useful life. I taught you this in IAS 38. An intangible asset with an indefinite useful life must be tested for impairment annually. Number two is goodwill. I don't know if Mr. Kazim have started teaching you group, but he will teach you about goodwill under group account. You see, goodwill must be tested for impairment annually, especially goodwill acquired in a business combination. That's the one we are talking about. This must be tested for impairment annually. Okay. Now, we have dealt with indicators. Now, let's go to measurements of recoverable amount. So I cannot overemphasize this. I already told you what it is already. So I will just move to the next one. But let me remind you that recoverable amount is the higher of the asset fair value less cost of disposal and its value in use. I've already mentioned that severally. And I've told you that fair value less cost of disposal can also be called net realizable value. And it's just the market price of the asset. Why the value in use is how much you can get from using the asset. But the way we determine it is by getting future cash flows from the asset, then discounting that to present value. And don't forget, this value in use, it includes how much you can even sell the asset it includes the scrap value. It includes this. You're going to get the present value of all of that, including the scrap value. Okay, so that's what all of these paragraphs are explaining further. So let's solve a question on this. And this question states that a company has a machine in its statement of financial position at a carrying amount of 150. The machine is used to manufacture the company's best-selling product range, but the entry of a new competitor to the market has severely affected sales. As a result, The company believes that the future sales of the product over the next 3 years will be only 75,000, 50, 25. The asset will then be sold for 12,005. An offer has been received to buy the asset immediately for 120, but the company would have to pay a shipping cost of 25. The risk-free interest rate is 10%, and the impairment review confirms that the assets might have been impaired, determine the impairment loss. Now, with this I can see that the carrying amount of the assets is 150. They now told us that, from here, they are telling you what is causing, what would trigger impairment test, that there is a new competitor in the market and it has affected your sales, right? So they gave us the future sales of the product for 3 years, and also how much you can sell the assets after that period, at the end of that 3rd year. Then they also said somebody gave an offer to sell the assets or to buy the assets immediately. And they then gave us how much you will incur to sell. And they gave us some rates. So they want us to calculate impairment loss. Impairment loss is just the difference between your carrying amount and recoverable amount. So to determine impairment loss, you just need to compare recoverable amount with carrying amount. So first, let's determine those two. So the carrying amount, they give us an equation as 150,000 here, 150K. The recoverable amount, I already told you, is the higher between the fair value less cost to sell and the value in use. And firstly, let's determine fair value less cost to sell. Fair value is the selling price. How much you can sell the assets immediately today, not in the future, today. And in this paragraph, they already told me how much I can sell the asset. And they told me I can sell the asset for 120,000. But in order to sell it, I will incur shipping costs of 25. Shipping cost of 25. That's the selling cost of this asset. Shipping cost of 25. So my recoverable amount, my net realizable value, is 117,500. Now they now gave me, so I've gotten my net realizable value. So they gave me the sales I can make from these assets for 3 years and the eventual disposal of this asset after that 3 years. You see, this is a clue towards determining value in use, because they have given me future cash flows. I just need to discount them to present value. So my value in use, my years, year 1 to 3, they gave me some cash flows. Year 1, 75, year 2, 50, year 3, 25, and year 3, 25. They gave me 12.5, which is how much I can sell the asset eventually. It's also an inflow. They gave me a discount rate of 10%. To get the present value of these amounts today, I'll do 1 plus r raised to power minus n. This gives me the discount factor. If I multiply this discount factor by this cash flow, if you punch your calculator, it gives you 68,182. And you know that the way you got this discount factor is from this that I wrote here, 1 plus r raised to power minus n. In year 1, that minus n will be minus 1. In year 2, it will be minus 2. In year 3, it's minus 3. Then, like that. That gives you these discount factors, which you are going to multiply by each of the respective cash flows for the respective years. You get this present value for each year. When you add all together, you get 137,678, which is the value in use. The higher between this 137,678 and this net realizable value of 117,500, the higher is the value in use. That means that my value in use is my recoverable amount because my value in use is the higher. So if my recoverable amount is 137,678 and my carrying amount is 150, that means my impairment loss is the difference, which is 12,322. So this is how you typically would determine an impairment loss. Typically. However, when we have an impairment loss, how do you then account for it? So this one should be is how do you account for impairment loss? So when you have an impairment loss, the impairment loss I have mentioned to you, especially for an asset that you measure using historical cost or cost model, that impairment loss should be recognized immediately in profit or loss. It should be recognized immediately in your profit or loss. That is, we're going to debit P&L and credit the asset. Debit P&L and credit the asset. However, if this asset is measured using revaluation model, you need to be very careful. If you remember what I taught you on revaluation deficits, it's the same thing that applies here. Because if there was a previous revaluation surplus on that same asset, that impairment loss in this case will not go to P&L, but rather it will go and eat that revaluation surplus in OCI first. It will go and eat it in OCI. It's only if there is excess that will not go to P&L. Just the same thing I taught you in valuation deficit, if you still remember. So that's just the only new thing here for assets that an entity uses revaluation model. So impairment loss, you won't take it to P&L as long as there is a previous surplus, evaluation surplus on the same asset. If there is a previous evaluation surplus, you take that impairment loss to that surplus in OCI. Okay, but if there is no previous surplus, then the impairment loss can go its normal natural route to P&L. P&L, straight on debit. But if there is a previous surplus, you take it and eat it against that surplus first through a debit to OCI, through a deduction in OCI. So it's only if there's any excess that you can then take to POL. So that's how you account for impairment loss. Now, one more thing before we solve some other few questions. One more thing. And that's what we call cash generating unit. Cash generating unit. So why this is coming up is that there are certain assets that you might not be able to calculate impairment loss on them. Like, for example, furnitures, air conditioner, laptop, elevator. You see, all these assets I'm mentioning, one thing they have in common is that they don't generate money directly to the company. They don't generate money directly to the company. Your air conditioner, it doesn't make money. It just make the office comfortable. The laptop you use to work, you only facilitate the work. Your elevator, the furnitures, they don't generate money directly. You see, these type of assets that don't generate money directly, it will be difficult for us to get their value in use. It's impossible. And if you don't get value in use, how would you want to get recoverable amount? Since recoverable amount is the higher, between value in use and net realizable value. So that's a challenge. Does that mean those type of assets will not impair them, or we will never test them for impairment because we can't get their value in use because they don't generate money individually? So that is why cash generating unit is coming up. That the only solution is that instead of treating this asset individually, at least for the purpose of calculating their value in use or for the purpose of testing them for impairment, why don't you group them together? Assets that generate money together. Like instead of looking at elevator, AC, furnitures as separate assets, why don't you group them together and see them as one singular asset? Like instead of just take the whole building, including everything in it as an asset. At least for the purpose of impairment, just for us to get, okay, this is the cash generating unit. Sorry, just for us to say that, okay, yeah, this is the value in use, and we can compare that with net realizable value, then we impair. See, as far as IAS 36 is concerned, if you are following me, that is why cash generating unit is coming up. And if you look at this definition of cash generating unit, is the smallest identifiable group of assets that generates cash inflows that are largely independent of the cash inflows from other assets or groups of assets. Smallest identifiable group of assets that generates cash inflows that are largely independent of the cash inflows from other assets or group of assets. And I've told you that grouping these assets together has only one purpose in life, as far as IAS 36 is concerned. I mean, this is one of the rare places where you find CGU. You might not find it again. The only reason why we are coming up with CGU is just for us to ensure that, okay, we can test this set of assets for impairment. Because if we don't group them together, we will not be able to get their value in use. And without their value in use, we cannot get recoverable amount. And without recoverable amount, we cannot get impairment loss. So value in use will ultimately ensure that we impair assets for impairment loss as the case may be. So that is why value cash generating unit is coming up. It's just grouping those assets together and knowing that, okay, how much do they make? And I give you some examples of assets like that they have different parts, that each of those parts, you cannot really say that this is how much they make unless you'd put them together. Then when they are one, we can easily know how much they make. And because we need that information, how much they make, I mean, from using them. If you don't have that information, getting recoverable amount will be difficult, right? So, cash generating unit. Now, so now, when you now have your cash generating unit now, we can then get cash generating unit of then we can then get the recoverable amount for the cash generating units. And don't forget, cash generating unit is group of assets, oh, don't forget. So we will now compare that with the carrying amount of that cash generating unit. Don't forget, cash generating unit is group of assets. So now when we now do that now, then we can then get impairment loss for that cash generating unit. So we have achieved our aim now. We have gotten impairment loss. Now, when you now get impairment loss, you now need to unbundle, because in the books, there is no account like cash generation unit. Like I've told you, the only reason for cash generation unit is just to determine impairment loss. Now that we have impairment loss for that group of assets, then we then have to, how do we then treat that impairment loss? Which account will it go? Because as you are, we know that impairment loss goes to P&L. Fine. but there's a corresponding credit that goes to individual assets. So what portion will go to each of those assets then? Because we are talking about a group of assets here. So now we have gotten the impairment loss for the group of assets. Then how do we then share that impairment loss among them? And that's where this guy is coming in. He said that the loss should be allocated between the assets in the cash generating unit in the following order. So this order is very important. You need to learn it because I can't always ask it. Number one, you're going to allocate impairment loss to an obviously damaged or destroyed asset. That's the first one that you allocate impairment loss to. So that's the first one. Then the second one is goodwill. So if there's goodwill within that cash generating unit, then you allocate to that as well. Then any other asset on a pro rata basis. Any other asset on a pro rata basis. And this order makes so much sense, really. It makes so much sense. It makes so much sense that we should allocate loss to a damaged asset. Because when you have a group of assets, the major reason why they will have been impaired is because of a damage or a destruction. If one of them is damaged, it can affect the value. So that one is one that should take the fall first. The second one is goodwill. See, goodwill is very, very flexible. Looking at the way I explained it to you in our yesterday, it's like a brand name, right? It's not something you can easily attribute a value to because the major builds of goodwill is around good behavior of your staff, the quality of your products, the location of your office, stuff like that. It's a good name. So a singular action of someone of a very lackadaisical staff can destroy that goodwill within a split second, within a millisecond. So it's also very flexible. That's why it's coming next. Then other assets on a pro rata basis. This pro rata basis is like on a proportionate basis. Okay. Okay. So before we solve questions, now, when you allocate impairment loss to any asset, as the case may be, so ensure that the impairment loss you allocate doesn't reduce the asset to something lower than the higher of either fair value or value in use. Because, like I told you now, the entire objective, if you remember the first objective, is that the book value should not be higher than recoverable amount. So the intention of this standard is just to ensure that what you put in your books is reflecting your recoverable amount, which is the higher between fair value and value in use. So when you are now allocating impairment loss to CGU, you need to watch out. This is particularly important. Particularly, would always test this. Always, use always, every time. So ensure that when you're allocating impairment loss to CGU, that don't allocate, because when they say other asset on a pro rata basis, you might find yourself allocating impairment loss to an asset that the value might now be lower. The new value might now be lower than its selling price. That's a problem. So that means you're now undervaluing your asset. We don't want that. So when you allocate impairment loss, it should not be reduced below the higher of its recoverable amount, which is fair value or value in use, or zero, right? I mean, zero. You don't want to have a negative figure. So when it gets to zero, maybe you should leave it. I mean, that is a scenario where fair value and value in use are zero. So just let it be zero. Okay, now let's start solving questions. So We have Minimart. Minimart belongs to a retail store chain, Maximart. Okay. So Minimart makes all its retail purchases through Maximart's purchasing center. We're now told that pricing, marketing, advertising, and human resource policies are decided by Maximart. Maximart also owns 5 other stores in the same city as Minimart and 20 other stores in other cities. All stores are managed in the same way as Minimart. Minimart and 4 other stores were purchased 5 years ago, and goodwill was required. What cash generating unit does Minimart belongs to? Okay. So they want us to tell them what cash generating unit does Minimart belongs to. Look at this question now. So there is Minimart. So it belongs to a retail store chain, Maximart. So it's just like what popular store do we have? Let me say ShopRite now. So let's say ShopRite has some other small branches around Lagos, right? So those other small branches is what these guys are calling Minimart. And the major company itself, Maximart. Okay. So they now say that Minimart makes all its purchases itself, its pricing, marketing, those ones are determined by the main retail store, Maximart. And of course, Maximart's own other 5 stores like Minimart, okay? So all stores are managed the same way as Minimart. Minimart and 4 other stores were purchased 5 years ago. Okay, so I mean, Minimart is just like a branch of Maximart. That's the major point here, and it makes his own purchases. So is Minimart, what car generating unit does Minimart belongs? So again, let me remind you of what car generating unit is, because I defined it to you from the perspective of assets that cannot make money on their own, and you need to put them together so that we can be able to calculate how much they make together. And if that's the meaning of cash generating units, which is a unit that makes money, then Minimart is a cash generating unit on its own because it makes money on its own. You just need to supply and make sure you advertise. It makes money. It is a branch. I mean, the major significance of being a CG is the fact that you make money. We can attribute that, okay, this is the amount you make in a month, in a day, in a year. This is what you make. Then you're a CGU. So that solves this question. Okay. Now, so let's solve another question. Let's solve another question. So there's this question. It says a cash generating unit comprises the following: building, we have plant and equipment, goodwill, and we have current assets. So this is CGU. And I said, following a recession, an impairment review has estimated recoverable amount of the CGU to be 25 million. So how do we allocate the impairment loss? Okay, good. So first, how much is even the impairment loss? Is 8 million, because the CGU now, the carrying amount is 33 million, and the recoverable amount of this CGU is 25 million. So The difference is 8 million. So this 8 million now is what they are asking, how do we allocate? Like I told you, the order is first, you're going to allocate to a damaged asset, then to goodwill, then to other assets on a pro rata basis. In this case, in this CGU now that we have, these assets that we have, we were not told that any of them is damaged. So that means the first will be applied against goodwill. The first will be applied against goodwill and against other tangible non-current assets on a pro rata basis. So when you look at goodwill in this question, you will see that the value of goodwill is 5. By the time you allocate 5 out of 8 to goodwill, right? So there will remain a balance of 3 million. You see, this 3 million is going to be prorated over the remaining assets, which is building, plants. We are not going to allocate to current assets here. We won't allocate current assets because we don't know. We don't know the component of these current assets because inventory, trade receivables, and some other current assets are dealt with under some other standards. The way their impairment loss is determined is different from how we determine it here. So, except the examiner specifically tells us that this current asset has been impaired or that we should impair it, except for that, don't allocate impairment loss to current asset. Just leave it. So the remaining 3 million will be shared between building and plant and equipment. So which is 80 million. So how do we do it? So the carrying amount of each of those assets for building, the value 15, plants 3, goodwill 5, current asset 10. So the impairment loss that we calculated as 8 million. First, we are going to allocate 5 million to goodwill. So the carrying amount after impairment for goodwill is now 0. This current asset, we are not touching it. We are not allocating anything to it. So it becomes 10 million. It's still the 10 million. Building and plants. The remaining 3 million, we are going to share it among those two. Look at the workings of what we mean by pro rata basis. For building, it will be 15 over 18 times 3. This 18 is the total of the two. It's like we're using ratio. It's like 15 ratio 3. 15, 3. So building will take 15 over 18 times the remaining impairment of 3 million. If you punch your calculator, that will give you 2.5 million. Then plant and machinery is 3 over 18 times that remaining impairment loss. That gives you 0.5. So we have shared the remaining 3 between 2.5 goes to building, 0.5 go to plant and machinery. So we put them here, 2.5, 0.5. So by the time you take away 2.5 from 15, remaining 12.5. By the time you take away 0.5 from 3, remaining 2.5. And that is all for this question. We have allocated the impairment loss of 8 million between the individual assets in the cash generating units. Okay, now if you have a question now, you can ask, because we are done with the major principles in IAS 36. Any question? Okay, now you see, it's possible for impairment loss to be reversed. It's possible for it to be reversed. And usually you can reverse it when an asset that was having that its carrying amount was being higher than its recoverable amount before. It now becomes a situation where you are now having a surplus, where the recoverable amount is now higher. That means you need to reverse that previous impairment. And of course, that reversal, it should be recognized to P or L immediately. I mean, you are going to treat it the same way like we treat revaluation surplus, because even though revaluation surplus goes to OCI, but when there is a previous revaluation deficit, that has to go to P&L before any assets can go to OCI. So when there is a reversal of impairment, that reversal of impairment, you take it to P or L immediately. And of course, the other leg is that you're going to now increase the value of the asset to its recoverable amount. You increase the value to its recoverable amount. And of course, we need to ensure that even though you are reversing, we always keep track of the carrying amount or the value of an asset before the original impairment. So, because some people might want to be smart, maybe before you even did any impairment, the value of your asset was 10. You now say, okay, there was an impairment of 2. So you wrote down your assets to 8. In another year, you now say, there's a reversal that you now have a positive of 3. You now want to take your asset to 11. We will not agree. You will say you want to cheat. Your asset cannot become 11. We will restrict it to this 10. So when you are reversing an impairment loss, the reversal must not result in a new amount that is now higher than the original value of the asset before impairment. No, because we believe that doing this is just trying to be smart. I mean, you had this in mind all along when you started. So why should a reversal result in an amount that is now higher than its original amount before the original impairment? So, I mean, you should actually take note of this also. So the final thing is disclosures. So what do we disclose? Of course, you need to disclose the impairment loss that you recognize in P&L. If there is any reversal, you need to also tell us about the reversal, how much reversal was made. You need to also disclose the amount of impairment loss that have been recognized to OCI. I mean, an impairment loss where there was a previous surplus will go to OCI. Right? So, and if you have any impairment loss or any reversal of an impairment loss that is material, you need to disclose that and explain the events that led to the reversal and also the nature of the assets. All that has to be clarified. So these are disclosures requirement for an impairment loss. And that is it for impairment loss. So before the end of our class, let's look at this question also. So this question states that As a result of privatization and commercialization exercise currently going on in the country, the Ministry of Transport sold the assets and liabilities of the newly constructed standard gauge railway to a private company known as Starlus Rail Limited to ensure smooth operations of the railway services by freeing it from government bureaucracy. So the first thing here, this first paragraph is saying that government sold the railway to Starlus. That's the major thing there. So the next paragraph, it says the summarized extract of the statement of financial position at fair value of SRL on January 1st, 2019, reflecting the terms and conditions of the sales agreement of the Transport Ministry as follows. So, they gave us the statement of financial position of SRL. So they gave us goodwill, operating license, property, wheel tracks, engine, and also the purchase consideration. Then liabilities nil. So I want to believe that this purchase consideration is the addition of all of this. In fact, it is the addition of this 150. By the time, if you add them together, it should give you this. This is the total. This is how much this company bought that station from the government. So this is everything. These are all the assets of them right now. And this is the total. And they have zero liabilities. Okay, fine. So they now set the operating license. I'm sure they are talking about this operating license. This operating license. They said the operating license is for a 10-year period. Okay, noted. It was issued on January 1st, 2019, noted, by the Transport Ministry, and it is stated at costs. Fine, okay? So this is the cost of that license, costs. Also, they said the carrying value of the property and rail track are based on their value in use, okay? Where is the property and rail track? Property, okay, and rail track. They said is their value in use, okay? They said the engines are valued at their net selling prices. The engines are valued at their net selling prices. Where's the engine? Okay, this is the engine. Net selling prices. Okay, two engines. That means each of them will be, that will be 375. Yeah, that's 375 for each of them. Okay. Okay, that's that paragraph. So what this paragraph is just talking about is just picking each of those assets one by one and telling us the one that is at cost, the one that is at value in use, and the one that is at net selling prices. All those things, all this information are useful to us. We're going to need them. Okay, that's in January. Now, the next paragraph, that's February. On February 1st, 2019, one of the train engine got damaged. That's an indicator of impairment. One of the train engine got damaged due to a technical fault from the manufacturer, and the engine was completely destroyed. Wow, it's gone. Completely destroyed. So the sale of the assets to SRL is without recourse to the Transport Ministry and the manufacturer of the engines. Okay, so they are quickly telling us that you cannot go and meet the ministry that sold you the train and say that, one of the engine has been damaged though. Can you return my money? You cannot do that. It is without recourse. So I've already told you that if anything should happen, you are the one that will take care of the cost though. So it's without recourse to the transport ministry and the manufacturer of the engine. Okay. In view of this, it was determined, it was estimated that there would be reduced passenger capacity. Therefore, the estimated value in use of the old train service business of SRL was estimated at 1.5. Okay. So then I said, because of this damage, so I guess they now did an impairment test on the CGU because they said value use of the old train service business. That's a CGU. Like a CGU. I mean, engine cannot make money on its own. License cannot make money on its own like that. So they need to bring all of them together and get, okay, what's their value in use? How much can they make? So they saw that as it is right now, it's 1.5 billion. Well, that's unfortunate because this guy paid 2.2 billion, 2.2, and they can only make 1.5. That's an impairment loss, obviously. Okay, next paragraph. They said that the number of passengers after one of the engines of the train got damaged was now below expectation. Even allowing for a reduced capacity. In the light of this, the value in use was reassessed again in March, and it is now 1.3. Oh, very sad. Very, very sad. It has even reduced further. Now, I'm sure this guy is now considering that this thing is not profitable again. So on these dates, this company, SRL now, he is now receiving an offer. Somebody is saying he wants to buy the company. He wants to pay 75 billion. Okay. And the guy said he wants to pay for the license. I mean, license is transferable now. I mean, it's transferable. It's an intangible asset, identifiable, non-monetary, without physical. It's an identifiable asset. If you remember what I taught you now yesterday. So it's transferable. So the realizable value of other assets has not changed significantly. Required. Draft a memo addressed to the MD of Stalos explaining the basis of allocating an impairment loss to the asset of CGU in accordance with IAS 36, 6 marks. B, calculates the carrying amount of the asset of SRL Limited as of February 1st, 2019 and March 1st, 2019. That's another 10 marks. Number C, explain two conditions that must exist before an impairment loss can be reversed. So the A part, where we were required to explain, draft a memo. These are ICANN pass corrections anyway. So when they say draft a memo, my dear students, draft a memo. So address it to the MD of Stalos and explain the basis of allocating impairment loss. Look at it. So this is my memo. The name of the company, Stalos. Memo from me, the accountant, to the MD, because the question says address it to the MD. Subject, the basis of allocating an impairment loss to the assets of a CGU. The basis of allocating an impairment loss to the asset of a CGU. So, dear sir, the above subject matter refers A cash generating unit is the smallest identifiable group of assets for which independent cash flows can be identified and measured. Allocation of impairment loss of a CGU, number one. Any identified impairment loss on the specifically damaged assets should be used to reduce the carrying amount of that assets first. That's damaged assets. Number two, the remaining impairment losses after the above should be charged against goodwill. After goodwill has been reduced to nil, any other impairment loss remaining should be allocated and charged to other non-current or non-monetary assets on pro rata basis, right? So, and I said that monetary assets such as trade receivables should not be exempted from allocation. That's provided the examiner tells you that, okay, they have been impaired. And when you are finally done your allocation, ensure that the carrying amount is not reduced below the highest of fair value less cost to sell, value in use, and zero. Don't write them below the higher of any of these three. Thank you very much. My name is Mr. XYZ, and I am the accountant of Stalos. Okay, that's the memo for this A part of the question, 6 marks. For the B part, it says calculate the carrying amount of the asset of SRL Limited at February 2019 and March 2019. Okay, so for February 2019, from the question, what I can see in February is that one of the twin engines got damaged. Yes, it was completely destroyed. They now did the estimated value in use of the old twin business to be 1.5 billion. Okay. So first thing we need to do in February is to calculate impairment loss for the twin station, which is the carrying amount, which is 2.2, minus the value in use of the twin station. That will give me like 750. Okay, let me show you. So now I've gotten 750 from what I've explained to you, 2.2 minus 1.5. Now, this 750 now, impairment loss, it should be allocated to those assets. These are all the assets: goodwill, operating license, property, stations, road tracks, then train engine. So it will be allocated to these items in the CGU in the order I've just mentioned. Number one is to a physically damaged asset. So we're told that one of the twin engines got damaged. Since there are two engines and the values is together is 750, that means one of it will be 375. So the 750 impairment loss, out of it, 375 will be allocated to the engine because it's completely destroyed. So by the time you remove 375 from this 750 value, the carrying amount as at February is now 375, which is the remaining one engine. That's the first allocation to a physically damaged asset. The second allocation will be to goodwill. And the value of the goodwill is 150. You allocate it to it. You allocate everything. 150. So the goodwill becomes 0. The only instance where you might not be able to accommodate all of this is if the remaining impairment loss is not enough. Like, let's say the total impairment loss is 400. You have not given 375 to this guy. It's now remaining 25. That means you can only allocate 25 to goodwill. But now the impairment loss is 750 that we have. having given the damaged engine the entire value because it's lost, it's destroyed, we still have more than enough money. So we allocate 150 to the goodwill. Then whatever is remaining, we're going to allocate it to the remaining 3 assets on a pro rata basis, right? And this is the workings for that. So the license, the property stations, and the road tracks, those are the 3 assets remaining. For the license, is 900 because that's the value of the license. If you look up here, you see the value of the license, 900, over the value of the 3 assets together, the remaining asset we want to allocate to, which is 900 plus 225 plus 225. These are the 3 remaining assets. So 900 over the total, the addition of those 3, multiplied by the remaining impairment loss. Remember, the total impairment loss is 750. We have allocated 375 to engine, 150 to goodwill. Whatever is remaining, we are sharing it among these 3. So when you do the maths, we are allocating 150 to operating license, which is this 150 to operating license. So operating license will fall from 900 to 750. Then to property stations, the same way we did for operating license, 225 over the total times that 750 minus like whatever is remaining, then that gives us 37.5 for the property stations. Then the same thing for the road tracks. That's also 37.5 billion. So what we have simply done is that when out of this 750, when we allocated 375 to the damaged engine and 150 to the goodwill, what was remaining, we had to share it among these 3 guys using these workings I showed you here. So having done that, you will see that the carrying amount is now reduced to that new value in use, which is that 1.5 billion. It has to be that. That is as at February. Now in May, because they asked us to look at the question, they want us to calculate the new carrying amount in February and in March. Okay. So in March, so first, remember that we have reduced their values to these values here. So those will represent the opening values here in February. So goodwill is no more. So it's remaining operating license, which is now 750. The property, which is now 187. The road track, which is now 187. And the train engine, which is now 375. So let's allocate the impairment loss. Because if you look at the question, what happened in March? In March is that the value in use is now 1,350. Remember, it used to be 1.5. So that means it has lost a further value of 150. And the only thing that happened in March is that somebody wants to buy the license from us, which makes the net realizable value of the license to now be 675. That's the selling price of the license, since somebody has given a firm offer. Okay, so how would that impact? So the first thing is that as a March, we know what our impairment loss is for the entire service train station, which is from 1.5, it's going to reduce to 1,350. So the impairment loss is 150 that we need to allocate to all of these assets in the CGU. In this case now, as a March, we don't have any damaged assets. We do not have any damaged assets, and we do not have goodwill. That means that this 150 should be allocated to all of these assets on a pro rata basis.
It should be allocated to all of them on a pro rata basis. So how do we get that done? Similar to what we have done, but care has to be taken. You need to be very careful because when you are allocating impairment loss, I told you that you must not reduce the carrying amount to a figure that is higher than, to a figure that is lower than the higher between fair value, value in use, and zero. Okay, you must not, in fact, you must not reduce it below its selling prices, right? And if you look at this train engine, they told us in a question that is their selling price. Let me show you. You might have forgotten. So they said that the engines are valued at their selling prices. Okay. So this 375, you cannot reduce it below this 375. Otherwise, we'll be undervaluing our asset. So that's why we did not allocate any impairment loss here. So the train engine is untouched. It's still 375 because I've taught you that you must not reduce the carrying amount to an amount lower than the higher between value in use, fair value, and zero. So that means for this one to be 375 and it's the selling price, whatever impairment loss you allocate here, will reduce it below. So it cannot be below it. It cannot, right? The license also, don't forget, somebody came that wants to come and buy this license for 675. That means this is the selling price of the license. You cannot depreciate below 675. That was why we just reduced this 750 to exactly the recoverable amount, which is 675. We reduce it to exact. That was why the only impairment loss we allocated is targeted to the difference between this 750 and the new carrying amount. Sorry, yeah, new carrying amount or its recoverable amount now. So we allocated 75 just to write it to its net realizable value or selling price. So out of 150, we have now allocated 75, remaining 75. Now, this will now be shared between these two guys on a pro rata basis. The same way, for the property stations, it will be 187.5 all upon the addition of the two 187.5 multiplied by the remaining impairment loss, that's 37.5. The road tracks 187.5 all over the addition of the two multiplied by the remaining impairment loss, 37.5. So we allocate 37.5, 37.5, and these are the remaining value after removing the impairment loss, and that brings us to 1350. Okay, so that is that for that question. So then the question also say we should explain two conditions that must exist before an impairment loss can be reversed. So I already mentioned that before you can reverse an impairment loss, there must be an upward there must be an upward movement in the value of the assets. That's a condition before you can reverse. And number two is that you must ensure that the new value is not higher than the original value of the asset before even the first impairment. I explained that to you. Before you can reverse, you must ensure that the new value is not now higher than the original value of the asset before the impairment. No, you must restrict it to the original value, ensuring that it's not beyond that. And that's the solution I have here for you. So there are some other questions here, though this is a question for professional students. You may want to leave that and you can attempt it. The solution is there for you. You can also learn from it. And there's one other question here for you to practice. So I guess that is the end of this class. Next week, I would either be teaching you financial instruments, or I might decide to teach you IFRS 15, either of them. So, but ultimately, this month is a defining month for us. Is a defining month for us. So we're going to cover a lot of major standards that we need to cover, so that by October, we can start solving some questions on, we need like 2 classes to solve five questions on published, so that all of these standards that will have taught you, we need to then see how you use it to prepare a standalone published question, putting all of these things together. But I want to have taught you a sizable number of accounting standards. Then you must have revised it. You must have good knowledge of them. Then you should be then able to apply them to prepare published financial statements. Let's leave those ones. We'll get there in October. That's what we'll battle with in October. But for now, let's focus on hitting those standards one after the other. So next week, most likely, I'm going to teach you IFRS 15. Then the upper week, I'll be teaching you most likely IAS 8. I'm not sure you have done IAS 8, so I'll teach you IAS 8. Then I will come to financial instruments. Usually those will be the 3 things I will teach you in September, and that's what I will teach you in September. Then in October, first 2 weeks in October, we'll solve published question. Then the last 2 weeks in October, one of them I'll teach you ratio. Then standards. There are some sundry standards I want to touch. Let's just move on, but I think we are moving in the right direction, and hopefully we will not have any cause to miss any class. Do we have any questions? Okay, thank you very much. See you next week, Thursday. Have a wonderful night.